companies are doing well because the companies do well look out 5, 6, 7 years, and some decisions they make may not be the right thing for the next year. The more and more we concentrate on what they're doing and we keep commenting on as outsiders, it's going to be run by an enormous committee, and we'll get committee results. So I don't think that's going to help anybody. But disclosure of relevant facts, of how many options people have, or the options at the market, what they're being paid, I think that's important, how many shares they own, what the company's doing. I think they used to not have a letter. I mean, it's not that recently that you have comments by the chief executive at the stop and hand report. They never used to have to make that. There's a letter saying what happened. I mean, it really is a very valuable piece of information. You don't realize this company spent a lot of time on this. It's a very serious document. I think it's very helpful to shareholders. The quarterly shareholder reports are excellent. And also, I've stressed, everybody in America can get a hold of a company. It's not Fidelity and Putnam and Dreyfus. You can get a hold of a company if you own 100 shares. You can call a company, somebody will talk to you about it. Then people don't take advantage of that. These companies are willing to talk. On this quantitative and qualitative risk ratings, I think if it could be done, I think it might be possible. I'm a little confused on it. I'm not that up to date on it. But I think people should understand, that certain stock funds, emerging growth funds that invest in companies that have 50 million or sales, and very small and much more volatile than when you're buying major quality blue chip growth companies, and that long-term bonds are more valuable than medium-term bonds, which are more volatile than one-year bonds. I think these are things that should be explained to people. People should get a menu like you get at Howard Johnson's.
How do you view Fannie Mae's stock and options today?
Well, I think I'd broaden it to Freddie Mac too. I think both of these companies, have a great business, and I always look at the stock market. I think of it more. If people study chess, this would be not a good game to study for the stock market, because in chess, an outstanding player will beat a good player 1,000 times in a row. Everything's in front of you. All the moves are known. It's all technique. In poker or in bridge, there's a lot of uncertainties. There's a lot of things you don't know. You can play a hand exactly right and lose. You say, but I played it right. If I do it again over a night, over a month, I'll do it. That's the stock market. The stock market is much closer to poker than it is to than any other game. And I think that's what's the important thing to know. And what the hell was the question? Fannie Mae. Fannie Mae has been sort of like a 27-card stud poker game, over 12 years. Cards keep getting turned over, like we're not doing so well in Houston, and this is 10 or 12 years ago, and with these 5% downs that a lot of people had in mortgages, and people moved there for jobs, and they brought their spouse along there, and the job left. They had no ties to those communities, and they left, or in Oklahoma or in Alaska.